us. He's partner and CIO at Roha Asset Managers and joins us to take some questions on the markets right now. Dhiraj, thanks a lot for joining us today and taking out the time for this show. We were so close to those all-time high levels, but there seems to be some, resistance at that point, specifically on the financials. How do you think this is likely to pan out, and do you think we're likely to stay range-bound at this level for a while now?
Yeah, hi, good morning. So we believe we are still in the early stages of an elongated bull market. A lot of investors now appear to be surprised about the recent rally, and so either sounding cautious or booking profits. This typically reflects the first phase of a market rally and is far away from having peaked out. So to our mind, corrections are likely to be short-lived. With positive economic indicators, increased manufacturing activity, and higher government spending, there will be support to corporate earnings going forward and will sustain this market rally. Besides relative slowdown in developed markets and the consequent shift in global emerging market flows in favor of India are other drivers of this market rally. So we are yet to see the second phase, or what is called typically the expansionary phase of the bull market, that is typically more elongated and robust. On the corporate side, if we actually see, we have seen a significant decline in global commodity costs like crude oil, steel, copper, including others, besides lower freight and energy costs and the ease of supply chain pressures, which is expected to aid margin recovery going forward. So also with inflation moderating, we expect a prolonged pause by RBI 24. So importantly, to sum up, Indian economy is witnessing multiple levers of a secular growth cycle. I mean, these include private CapEx, government-backed PLI program, and improved credit growth. And this will help corporate earnings and global flows to sustain this market rally. And to our mind, corrections like these ones on odd days are expected to be short-lived.
Okay, so you're not too perturbed about the little red that we're seeing on the screen, Dhiraj. Hi, morning. So tell us, what are you liking in the market? I mean, we've had a rally across most of the sectors, barring, of course, IT has been the laggard. And niche spaces, whether it's defense, manufacturing. So what do you have your eye on for the time being?
So our portfolio focuses more on domestic-centric businesses. I mean, themes like banking, financial services, travel and tourism, engineering and manufacturing are interesting opportunities. Now, we do like select companies in cement, pharma, and specialty chemicals, which could come back as your profits or EBITDA margins are close to bottom, and valuations are relatively attractive after their recent underperformance. We are avoiding companies that are largely dependent on exports, as we are underweight on IT. That has got recently validated by TCS or Infosys results, which reflected project delays or cancellations and even lower growth guidance. So net-net, we are more domestic-centric focused at this point of time.
Okay, got that. The other space I want to ask you about is the entire auto sector. I mean, of course, we've already seen a big run up this year. It's up 16-17% on just the index. Is this a space that you like? And then within autos, what would you look at? Is it, the standard CV players? Is it the two-wheelers? Is it the ancillary companies? Is there anything from this pack that interests you?
So the auto sector has so far reported a mixed set of numbers. While two-wheeler and commercial vehicle segment volumes came in ahead of our expectations, tractor segment volumes were lower than our expectations. So demand for entry-level cars remained weak, though SUV segment is doing pretty well. And also pre-buying before the BS6 transition norms is driving commercial vehicle volume sales. Now, tractor segment volumes have remained steady, however, lower than expected rainfall and crop sowing remains an area of concern to our mind. So we have a positive view on select auto component companies with exposure to CV and passenger vehicle segments, where the replacement demand is also better. But they are also facing challenges due to a decline in two-wheeler segment volumes and continued weakness in export markets. So again, we are being very selective here in the segment.
Okay, that is on the autos. The other big theme that we've been talking about is consumption, right, within India. How do you look at this pack? And take us through the split between, if you would look at just the urban-focused ones and the rural, how would you play the entire consumption pack?
So if I break down consumption pack between staples and durables, consumer staples, we expect resilient demand with expected improvement in the margins. I mean, they also face some kind of cost pressures in the past. Rural has bottomed out, but is yet to register a meaningful growth pickup. However, valuations in FMCG sector offer little comfort for any meaningful upside. On durable side, we expect the fourth quarter earnings of most of the consumer durables was lackluster, and we expect the same is likely to continue. I mean, if you see the air conditioner industries, it was likely to benefit from extended summer, but there's still channel inventory is pretty much high, which means that demand conditions are subdued at the primary sales level. In case of fans or refrigerators, again, tertiary demand has picked up given extended summer, though primary sales is yet to pick up meaningfully. And the channel inventory continues to be high. We expect that will get cleared only in the second half during the festive season. Demand for premium products is getting replaced versus mass products. But overall, we believe consumer durable valuations are not pretty attractive. So we are underweight on both staples and consumer durables at this point of time.
Dhiraj, coming to the entire defense pack, now I should have perhaps led with this, considering that this week is going to be very heavily focused on what we're seeing on the defense front. Of course, a lot of these stocks have moved up, and seen huge up moves in this year itself. But do you think this is set for lots more in terms of what we can expect in just the defense space? Because also, I mean, of course, we've been talking about the big HAL deal. There's that entire indigenization push. So do you think that this is going to be a long cycle? And even now, after this kind of run up, it makes sense to put some money to play here?
Yeah, so easy money is unlikely at this point of time because everybody is talking about defense and many companies are more ahead of their earnings cycle. Though it is a very elongated cycle because of the import restrictions and more localization efforts. So defense PSUs are doing extremely well, and there is a long runway to growth due to this reducing import content with restricted list by the government and more localization efforts. So private capex on the defense is also showing signs of further recovery, with government tender momentum continues to be strong on this area of defense equipment specifically. So while we believe that there is a long runway to growth, the valuations may have gone ahead of time in terms of their near-term earnings or next couple of years' earnings. And investors now have to be more patient to reap the gains because most of the easy money is out as a lot of euphoria is building up in the sector as well.
Okay, all right, Dhiraj, got that. Thank you very much. Good to have that perspective from you. And we look forward to our next conversation as well. By the way, the market is trying to sort of